Now it is time to get started. My name is Mary Biddle-Koenig, and I am the Assistant Director of the Smith Enterprise Risk Consortium, CERC as we call it, at the Robert H. Smith School of Business at the University of Maryland. I would like to welcome you to the April webinar and our monthly webinar series, which is brought to you by CERC, ZRG Partners, and the Office of Executive Education at the Smith School of Business. As many of you already know, our webinars are focused on top-of-mind risk topics that vary from month to month. We've covered everything from the issues and challenges in cyber insurance markets to the Basel III endgame to pharmaceutical supply chain risk and also to extreme weather events. Just to name a few of the topics that we have had. Today, we are thrilled to have Teresa Bazemore from the Federal Home Loan Bank of San Francisco with us to talk about reforming the Federal Home Loan Banks. To start us off, I would like to introduce you to Rob Iamazzo. Rob is a managing director of ZRG Partners and currently leads ZRG's global enterprise risk and analytics practice. We have partnered with Rob for many years to bring you the risk leadership webinar series, and I'm pleased to turn it over to him to kick us off today. Rob?
Thank you, Mary Biddle, and again, delighted to continue these very topical monthly webinars, and really delighted to introduce, obviously, Mike Frattantoni and Teresa again, or reintroduce, given what's going on currently in the overall housing market in the U.S., clearly with interest rates, et cetera. Very topical discussion. So thank you, Teresa, and thank you, Mike, for joining us here. And at this stage, I'm just going to turn it over to the both of you because that's who everybody signed up to hear. So thank you both, and here's to a great webinar.
Great. Thank you, Rob. Thank you, Mary Biddle. And I'm Mike Frattantoni, Chief Economist at the Mortgage Bankers Association. I'm also on the CERC Advisory Committee, so I appreciate the Smith School's support of this really important function. It is really my pleasure here today to talk with Teresa Bazemore about the Federal Home Loan Bank system and its importance for the U.S. real estate finance and banking markets. And I've had the pleasure to know Teresa for many years. So Teresa, really looking forward to this conversation. And our plan for today is really to take this in parts. I think to understand the importance of the Federal Home Loan Bank system, you have to understand the history. So we're gonna start there, why it was created, how it's developed over time. And then we'll dig a bit more into the structure and how the Federal Home Loan Bank system really is such an important risk management service for the banking industry. And again, how that works in practice. And Teresa, nobody better than you to talk about that. But then I think we'll also talk through our conversation and some of the questions that have already come in. There are ideas for reform of the system, so we want to talk about that. And Teresa, get your thoughts on where we might go from there. So that's the plan. Does that sound good to you?
That sounds great. And Mike, as you said, we've known each other for a long time, so it's terrific to be with you this morning.
Excellent. So let's just dive right in. First, let's talk about the history. Why was the Federal Home Loan Bank system created?
So the Federal Home Loan Bank system was created in 1932, and it's a GSE, government sponsored, but it was set up as privately capitalized. So the original members, as Congress had deemed them, were building and loan associations, which later became savings and loan associations and insurance companies. And those were two categories of financial institutions that were active in the mortgage industry at the time and in housing. It's an interesting sort of report. You lead REHA at the MBA, the Research Institute for Housing America. And ironically, while I was the chair of REHA, one of the studies that came out is about what was going on in the industry between 1910 and 1940. And I think it informs a lot about sort of the history of how the Federal Home Loan Banks came about, as well as the FHA and then Fannie Mae. So, and so when you look at it, the point was for us to be able to provide on-demand liquidity to make sure that the institutions that were in the market continue to be viable. Back then, a lot of these institutions were keeping these loans in their portfolios. They had to have a way to manage that liquidity. I think back to It's a Wonderful Life, right? If George Bailey had had membership in a Federal Home Loan Bank when he was having a bank run, he could have called the Federal Home Loan Bank. So I think that's important. There are 11 regional Federal Home Loan Banks. That's how it was set up. And we have also the Office of Finance, which is how we raise the debt that we then in turn loan through advances to our membership. And there's the Council of Federal Home Loan Banks, which you can think of as more of the association of partially how we work together to think through our various policy issues, et cetera.
So you mentioned the Research Institute for Housing America study that we had done. I encourage everyone go to housingamerica.org. We re-released that paper just given the interest in mortgage lending and the Federal Home Loan Bank system. And as you indicated, it really is fascinating to think about that history there, that if you think about in the 19th century, you were in a situation where you had insurance companies and some others on the East Coast and, your Boston and New York that were just flush with deposits. And you had this dire need for finance in other parts of the country. So you would have mortgage bankers in Chicago or, a further out west who would sell these loans back to insurance companies in the East. And so this notion of insurance companies as central as sort of long-term holders of mortgage debt, this goes back a long time. And so, talk a little bit more about who were originally members of the Federal Home Loan Bank system. You mentioned the building and loans, savings and loans, but the insurance companies as well.
Yeah, so the insurance companies, to your point, were really active in the mortgage industry back in those days. And interestingly, they sort of held a lot of these loans, and they still do hold a lot, because there's been an evolution. A lot of that is held through RMBS or
right.
CMBS. Although some insurance companies do lending for multifamily more directly. So they continue to stay in the market in different ways. I mean, my first job, frankly, in the residential mortgage market was at the Prudential. So, and so the insurance companies have continued to support that. And what's interesting is you need folks who are willing to hold these assets over time. And when I think about the Federal Home Loan Banks, we really enable that sort of portfolio holding, right? So whether it's someone holding like a credit union, we have a lot of credit union members. That was a category that was added much later in time. But a lot of credit union members, for instance, who hold these loans in their portfolios, they don't sell them. They need to be able to manage the risk associated with holding those assets in their portfolios. Insurance companies continue to hold these assets in their portfolios, often through securities, but nevertheless, you need holders of those securities. And I think of our system as a way to help institutions do that in support of the industry.
Makes sense. So let's talk a bit more about how the system's evolved over time. So how has the membership changed? How has the structure of the system changed? Just talk a bit about, from the creation in the 30s through the 20th century till today, how have things evolved?
Yeah, so really it was pretty much dominated by savings and loans up until the crisis, right? Or the savings and
Late
loan.
80s, right? Yeah.
Right. And at that point, Congress came in and decided to expand the membership. So the membership was expanded in 1989 to include commercial banks and credit unions. And then again in 2008 under HERA, it included community development financial institutions, or CDFIs. When you look at the systems today, it started out as 12 Federal Home Loan Banks. We had a voluntary merger between Des Moines and Seattle in 2015. But there's still 11 banks. We support about 6,000 financial institutions across the US, when still all of those categories. And the point is really sort of two parts. One is the original mission, right, which was to create or to have on-demand liquidity for credit-worthy members. And we continue to do that because we know that that allows for the health and vitality of the financial institutions in our country, and also, frankly, gives smaller institutions access to liquidity into the debt markets in ways that they otherwise wouldn't have access. It's one of the reasons that we believe that we have the diversity in the US of institutions that we have. If you think about other countries, they're typically just a handful of banks. Here in the US, we have many institutions that that we support, and we believe that brings a vitality. And also, it's great for smaller businesses. You know, small businesses important in the US. Those institutions are often really important when it comes to supporting small businesses, when it comes to also financing some of the smaller multifamily projects, you know, understanding the markets and the mortgage markets in their areas. So that's how we've thought about that. In 1989, also as part of FIRREA, there was an addition. So this sort of liquidity mission has been sort of reaffirmed by Congress a few times over the years. But it was to add the affordable housing program. And the affordable housing program, which was added in 1989 and launched in 1990, requires each of the federal home loan banks to take 10% of their net income from the prior year and use that for affordable housing. And those are in the form of grants. So there's sort of two parts to that program. One is that we can take up to 35% of that amount, and we can use it towards down payment assistance for families who are at 80% or less of area median income. We call that in San Francisco our WISH program. In fact, we just released, you know, the amount that we're doing for this year a couple of days ago in a press release. The other part of it, the great majority of it, so at least 65% of those funds are in a competitive grant program. And every federal home loan bank does a targeted lending plan. It's really based on an assessment of what the needs are in the region that we serve for. So for us, it's California, Arizona, and Nevada. And as you can imagine, for us, a lot of projects that we fund are to help with homelessness. And you know, and especially looking at veteran homelessness as an example, but also for very low income folks, rental housing. Now, some of it does go towards helping with building housing for purchase, but a lot of it really is to deal with the affordable housing crisis in terms of homelessness and folks who are very low income, to give them access to a home. So that's how the AHP came about and became kind of, I'll call it a dual mission of the federal home loan banks.
So really addressing the full spectrum of affordable housing needs, from ownership to rental to homelessness. That's quite a lot of territory that 10% affordable housing program is covering, right?
Yes, yes.
Yeah, excellent.
And I would say, you know, now many of us, you know, well, all of the federal home loan banks have decided to go up to 15%, but we're using the other 5%, and we can get into that to support both homeownership, economic development, affordable housing in ways that we see are needed in our various communities, but aren't necessarily covered by the structure of the current AHP program, which is, you know, pretty heavily regulated.
Yeah. So yeah, I bet we will get back to the AHP later in the conversation when we talk about reform. But given that this is a risk management audience, let's dive in a bit now more to sort of your day-to-day work. first, you mentioned 6,000 financial institutions as members, from banks to thrifts to credit unions to insurance companies. Can you talk about how membership is handled? How, if you have somebody that's not currently a member, how are they evaluated for membership? How do they join? What are they putting in as capital to start? How are they using that capital going forward?
So one of the things that I just want to point out initially, because I think there's a lot of confusion about it, is that, we are a membership cooperative and we're not a regulator, right? So, but we used to be. So when the system was first created, the Federal Home Loan Bank Board was actually a regulator for our members. And that was something that was changed later, and that was split off. But so first of all, Congress has determined those are the eligible member types, right? Which is one of the sort of policy questions that comes up in terms of what that should look like going forward. And so if someone applies for membership, the first question is, right, do they fall within one of those member types? Then they have to meet a number of criteria, including the fact that they have investments or participate in the mortgage market. They also have to meet a criteria in terms of their financial wherewithal, their credit worthiness. We essentially underwrite them for membership to make sure that they're credit worthy and they meet all of the regulatory requirements to become members. If they are approved for membership, then they're required to buy stock in the Federal Home Loan Bank. And that stock is determined based on their asset size. So there are two types of stock in the Federal Home Loan Banks. One is the membership stock. So that's what I'm talking about right now. And you essentially have 60 days from approval to purchase that stock. That stock never changes in value. So if you were a member who joined the Federal Home Loan Bank 50 years ago, and you paid, let's say $1,000, I'm sure it was a lot more than that, but $1,000, that stock is held at par. So it hasn't changed in value at all. Obviously, $1,000 50 years ago is different from $1,000
Right.
today. And that's where sort of the other returns on stock come in to play in terms of dividends. But then you have to have that membership stock. And then that gets sort of trued up on an annual basis. When you borrow, you also have to invest more capital into the Federal Home Loan Bank, and that we refer to as activity stock. From a risk management point of view, we reassess the credit worthiness of our members on sort of an ongoing basis. And that determines the amount that a member can borrow. So you have the first piece, which is becoming a member. Then the second piece is how much can you borrow? And depending on your level of credit worthiness, it will depend on what your we call it financing availability, but think of it as the percentage that you can, of your assets that you can borrow. And then that becomes sort of the high mark, if you will, which can change based on credit worthiness. And then the second piece then is we're required to have collateral, and that's also designated what the acceptable and eligible collateral is that we can take.
Yeah.
There has to be enough collateral, and we consistently mark the collateral mark to market in terms of the value of the collateral. That then determines the borrowing capacity. So let's say that you have financing availability of, say, $5 billion, but you might only have borrowing capacity because of the collateral that you've posted of $2 billion. That would be the most. And the reason why we structure it that way is because this is supposed to be on-demand liquidity. So one of the things that also gets confused is that when someone comes in, we already know what that borrowing capacity is. So if you were a member and you call, you really can get on-demand liquidity. And we're not sort of underwriting the purpose of the advance, right? But that's the structure of how we operate and how we sort of manage things from a risk perspective.
Well, let's dive in there a bit more. So you mentioned as one of the membership criteria, and again, this has come up in the reform discussion, that they need to have a certain level of participation in mortgage, in the housing market, a connection there. Again, you're the Federal Home Loan Banks, that makes sense. And then, so talk a bit more about that, and then let's talk about the eligible collateral. So when they're posting that $2 billion, and they may have a total borrowing capacity of 5, as you said, but they're posting to what's in that to, how do you evaluate the collateral, who's holding that, what haircuts are applied? Let's really talk some brass tacks.
Yeah, so this could vary from Federal Home Loan Bank to Federal Home Loan Bank because each of us, we're separate entities. We have our own sort of risk models and criteria. We're each regulated by the Federal Housing Finance Agency, and they review all of that on an annual basis. We have safety and soundness exams on an annual basis. So the entry point, which is part of what you're referring to in terms of the percentage, is interesting in terms of what assets a member has. But when you think about the eligible collateral, that's where I think you see this connection point, because at least at the San Francisco Bank, most of the collateral that we have is mortgage related collateral. It's about 85 to 90% of the collateral that we have. And but other, we can have mortgage, that includes mortgage and mortgage-backed securities, including some CMBS, which is usually multifamily type CMBS.
I was going to ask, so single family residential, multifamily, some commercial, yeah.
Loans and securities issued by the United States government, securities issued by any U.S. agency, cash and deposits that we have at the Federal Home Loan Bank on someone's behalf, and some other real estate related collateral. But those are really the types of collateral that we're allowed to take. If an organization is deemed a community financial institution, then they can also pledge small business loans, small farm loans, small agribusiness loans, and community development loans as collateral. But as I know, the vast majority of the collateral we have is really mortgage related collateral.
And am I right in thinking that you do have a haircut on the value of those when they're posted? Yeah.
Yes. And the other thing is that because of this concept of kind of having dry powder to borrow from time to time, we're also typically over collateralized. So in my example, let's say someone has $5 billion in financing availability, but they've posted $2 billion in collateral, but they're typically not borrowing up to their borrowing capacity, right? They're borrowing somewhere beneath that so that they still have some capacity in the future. So it's important because in a lot of cases, we have significantly more collateral for that reason than what's actually outstanding in advances.
That makes sense. So let's dive a bit more into risk management. First, sort of how does the work that you provide your members, the advances, how does that help them manage the interest rate risk that they have with respect to their holdings of mortgages or other assets? So let's go there first, and then I want to talk about risk management of your institution and how do you manage the Federal Home Loan Bank's exposures, which in many cases is a counterparty risk to these depositories. But let's start with the depositories. How is the service that you're providing, how is that helping them manage their risk position?
Yeah, so when we report sort of what our advances are, or even we report who the largest borrowers are, in terms of our members, you're seeing an aggregate number, right? So this particular member has borrowed X amount, but that's composed of a lot of different advances, right? They're structured differently. They have different tenors. They have different, they're potentially different products. And so that's all used to help them with their asset, asset liability management, their interest rate risk. Each institution is going to determine what makes sense for them. We work with them in a collaborative fashion to try to help them understand how to use those products. In some cases, some of our members may have loans that they're making, particularly in the multifamily space, where they're sort of trying to do some match funding. One of the important pieces about how our products are structured is that they can be longer term, particularly depending on what type of loan they're supporting, right? So if we're supporting a multifamily project, as an example, we can go out a bit longer. And so that is an important part when you think about how we work with our members. We also do conferences, we do education, we bring people in to talk about best practices in AML, management, ALM management. And so that becomes really important, I think, in terms of helping make sure that we are helping to be a stabilizing factor in the financial industry. The other thing that's important is that, and this may be going into sort of how we manage things, but we are required to hedge every advance too. So, so there's a sort of back end piece for us in terms of how we're hedging those advances. But it's an important piece because when you think about how someone's borrowed, it's a group of many different loans that they've taken out from us, and they've structured them in a way to best sort of do their own risk management.
Yeah. Let me bring in a question that we received from one of the attendees that I think fits in well here. So you mentioned the sort of the term structure of advances that a depository might have, but then you need to hedge on the back end of that. So you can talk about sort of the prepayment penalties that a depository may be subject to if they find themselves in a spot where they're paying off some of those advances early.
Yeah, and we think of them as prepayment fees, but it's regulatorily mandated. So, for instance, we're required to be, if someone prepays, we're required to be what's called financially indifferent. That's the phraseology, and it really depends on the structure. So of the advance that's been taken out. So some advances might not require a fee, some might. It really depends on that. But if it is one, the difficulty is that a lot of the prepayment fee, in fact, the vast preponderance of it often is the cost to unwind the hedges.
Yeah.
So if you think about something like an SVB, right, that was a huge part of what the cost was. It was to unwind what were a lot of different hedges. And then we're required in some cases to be, in order to be financially indifferent, we're essentially taking the present value of what we would have earned over the remaining term of that advance. So when you look at one of the recommendations that's in the FHLB at 100 report, it's about whether or not there ought to be some discretion that the banks have in a stress situation where an institution is, for instance, being taken over by the FDIC, to be able to waive a portion of, we couldn't waive the part that we're essentially paying out to counterparties, but the portion that is the piece that is sort of what we would then have present value on what we would have made over the rest of the term. And I think that's one that should really be taken a look at, because right now we don't have that discretion to make that call. And in that particular case, I think it would be good if we did have some discretion to be able to take a look at that and potentially reduce the amount.
Yeah, yeah. So yeah, so the questioner referred to it as a prepayment penalty, but for folks in finance, that more naturally you'd call it a yield maintenance kind of a clause, right? There's your point that
Yeah.
you're indifferent between when it's received. So I mean, yeah, you brought up at SVB, and that gets to questions around reform and regulation, but maybe we'll just start with, how are you regulated as an institution, as a Federal Home Loan Bank today? Talk about your regulator, talk about how that regulatory structure has changed over time, and then we'll dive a bit deeper into some of these other questions.
So as I mentioned, when the system was originally formed, we were the regulator, right? Or the system, I should say, was the regulator for the members. And that changed as part of FIRREA. And now it's the FHFA that is our regulator. They are a safety and soundness regulator. They look at, they examine us on an annual basis. They are responsible for putting into place any regulatory changes that are prescribed by Congress. They also review whether or not we are complying with our mission requirements. So they review whether or not we are administering our HP programs appropriately. They also review the Office of Finance, and I referenced the Office of Finance earlier, but the Office of Finance for the Federal Home Loan Bank system is how we raise the debt that we then loan out, right? So, and so they also regulate the Office of Finance. The debt that we raise as a system is joint and several. So we're all sort of raising it together. It's not each of the 11 banks, but it's the system as a whole. And so if you are an investor in Federal Home Loan Bank debt, it's essentially backed by all of us, all of our capital.
Yeah. Yeah, it is a very interesting structure, right? Where each of the banks are cooperatively owned by their members, and then the system has this connection where each of the banks is jointly liable for the actions of the others. And I mean, we want to talk about that, and sort of how does that operate in practice? Does that mean that the 11 banks, I'm imagining, are certainly aware of each other's activities and risk management practices?
Yeah, and so there, we actually have a committee of the bank presidents that's sort of a system risk, oversight committee that is for purposes of making sure that, everyone's comfortable with what's, being done. And then you've got the FHFA also making sure that, the risk that's being taken is a reasonable risk, right? That it's in conformity to appropriate practices to maintain safety and soundness. And if, you look at it, what that translates into is that we're able to raise money in the market at a lower cost that we're then able to pass on. But that joint and several liability is an important component of that.
Yeah. I mean, would you think that the cooperative structure of each individual bank and then the joint and several liability, does that make the system act conservatively, however you might describe that, and with respect to how they manage the business?
Oh, I think so. I mean, if you think about it, since the membership there are stockholders, as a management team, as boards of directors, we each have our own board of directors, which is composed of both member directors and independent directors. Our fiduciary responsibilities, are to our members and to preserve the value of the cooperative, in addition to, being there to do the mission that we're required to do. So, but, when you look at all of the layers of value, we underwrite the member, to determine how much credit they can have. We get collateral. We mark the collateral, mark to market. We're typically over collateralized. On top of that, We have the members' capital. We have retained earnings. I think we all have excess retained earnings. And then from the point of view of a bond investor, then they're also getting this joint and several. So there's sort of many, from a risk point of view, there are really many layers of protection. So the probability of default for, on if you're investing in our debt is pretty low, given all of those protections that are in front of it. And certainly, there's a lot of discussion about kind of the implied guarantee, which is in fact implied. And, presumably investors take that into account. But I think all of these other pieces of protection are very important too, in terms of how investors think about the safety of investing in our debt.
Yeah. Well, let's go to what you raised there for a second. This notion of implied guarantee, and there was recently a Congressional Budget Office study looking at the Federal Home Loan Bank system, and they've performed similar studies over the years with respect to Fannie Mae and Freddie Mac, and this notion of a government-sponsored enterprise has some sort of indicia, some indicators of connection to the government. Maybe that's an ability to borrow from the Treasury in an extreme moment, and just sort of a sense from global investors that the government might stand behind these organizations. Obviously, with Fannie Mae and Freddie Mac, they did. And the CBO report on the Federal Home Loan Bank system, same kind of methodology of saying, okay, how much support is being provided by the government, given the protections that you talked about being in place? These are very safe institutions. And there's this, again, this additional benefit of some implied support. So I don't know if you had a chance to look at the CBO report and your thoughts on how they're characterizing the nature of that relationship.
Yeah, so look, definitely as a GSE, I would say that even if you look at sort of the rating on our debt, right, there's some benefit that we get from the rating agencies in that regard. And while you can look at the number and say, are the assumptions the right assumptions, or would that bring the number down? I think what's more important in the report is that they talk about the fact that our ability to raise money, because what we're really doing is we're really raising money at a lower cost, right? So, and then we're passing that savings on, and they recognize that in the CBO report, we're passing that on through to our members. And so I think that's the important piece. And there was a Wisconsin study by Professor Zhang a few years ago, where he basically sort of concluded that a lot of this was being passed through to the ultimate consumer. I think, he estimated about 13 billion in savings from an interest rate perspective. And so I think when you tie those two together, you can sort of see that benefit that we're getting in raising debt at a lower cost is sort of passing through ultimately to the consumer. And interestingly, too, the other issue that comes up is that, we pay dividends, as I talked about. The stock is held at par, right? So if you're not borrowing, that's the only return you're going to get on your stock. But we also know that a lot of our members look at that as also how do they pass that through in terms of saying, what's the cost of this debt, and how do I borrow from the Federal Home Loan Bank versus maybe other sources of capital? And so that ends up factoring in as well into how they think about the cost of the debt ultimately to us. So I think hopefully that answers your question. But yeah, I think that we look at it and look at the CBO report and sort of agree that, yes, that benefit is being passed through to the institutions. And we believe that then those institutions are benefiting, as Dr. Zhang pointed out, the consumer.
Makes sense. So we talked about how your advanced business really helps your depository members manage their interest rate risk. Maybe just take a quick aside to talk about the MPF and MPP program, sort of another set of products that the system has available to help members with their mortgage business.
Yeah, so the MPP, MPF programs are really mortgage purchase programs. And for the most part, they serve a lot of smaller institutions that don't have access to Fannie and Freddie. You know, as a general proposition, if you're a large institution, you're going to have a better, execution going directly to Fannie and Freddie. So it's different in that regard. And I think of it as an opportunity for them to still be able to sell those assets. Typically, the servicing is retained. So because that's often important to some of those smaller community banks as well, to be able to hold on to the servicing.
Yeah, no, makes sense. And, there are often times, I certainly know through the pandemic, that our smaller bank members were having their own liquidity challenges and multiple avenues to try to quickly get access to liquidity, whether it was through advances or through the MPF, MPP programs were really highly valued.
Well, and I think it also gets to kind of helping to understand the difference, right, between Fannie and Freddie as GSEs and the Federal Home Loan Banks, right? Because really, Fannie and Freddie are buying loans and they're securitizing them. They're, selling the securities and essentially bringing that capital back in to buy more loans. Most of who we're working with are keeping loans in portfolio,
Yeah,
right?
yeah.
And using this as a way to sort of finance that. And that's been a particular issue, because if you think back, the Federal Home Loan Banks have what we sort of think of as an accordion nature, right? So we're there in, we frankly are day-to-day lenders to our members. About 50% of our members are borrowing on any given day. But the need for those advances sort of goes up and down. To your point, we see it happen more in a crisis situation, like at the beginning of COVID, where we saw the advances go up. And then you saw stimulus come into the marketplace through sort of government stimulus, PPP loans, all of those things. All of that money, much of that money came into the banks and credit unions, right? And then they deployed that money into loans, but loans at the rates that were in effect at the time.
Right.
Right. And so now you've got a portfolio of, say, 3% loans. The rates go up significantly, as we all know, over the next 14 months or so.
Right.
And now depositors in your institution are looking for higher returns. We started to see money move to the money markets, right? And so if you have a portfolio of these assets and you don't want to have to sell them off in a fire sale way, the Federal Home Loan Bank borrowings become a way to help sort of bridge that. And you can see, if you look at sort of where the system was at the end of 21, when the influx of all that money came in, the advances were very low. And then as rates started to go up over the course of 22, you see the advances start to come back up. Because frankly, when we went into 2022, we were wondering how long of a period this was going to be of very low advances. And by the end of 22, because of those rate hikes and the need to manage those portfolios, we saw it rebound quite substantially.
Yeah. No, if you look at the call report data across a number of institutions, right, you see exactly what you said of they were losing retail deposits and replacing some of that with wholesale borrowings, either, various forms of brokered deposits or other, generally some higher cost borrowings, or through the Federal Home Loan Bank. So very much filling that role. I think what you were saying.
One other quick thing just to note is that some of our Federal Home Loan Bank members are also warehouse lenders. to
That's a good point.
IMBs.
Yeah.
I didn't want to lose that point because sometimes what they're doing is our members borrowing from us, and then in turn they are providing warehouse lines to non-member institutions. So I didn't want to lose that point.
That's right. And, as you know, really important in this world where about 2/3 of originations are being done by independent mortgage banks, more than half of servicing by independent mortgage banks. And so the connection point to the banking system and that liquidity being pushed through your members to non-members, very, very important point. Well, let's get to something else that you raised. You mentioned SVB and First Republic and the other banks that, Signature, that were having challenges last spring. And that to many folks sort of brought up this issue of, okay, so if the Federal Home Loan Bank is really sort of the lender of first resort, that day-to-day liquidity provider, the Federal Reserve really kicks in as the lender of last resort in a real crisis situation, lending through the discount window. How do you think about the relevant roles of the two institutions, the Federal Home Loan Bank system and the Federal Reserve, as we move from day to day to crisis? And how does what the discount window provides in a moment of emergency, how does that differ in terms of collateral, in terms of process, in terms of practice from what you're providing?
Yeah, so I mean, the discount window typically is very short term, right? It's overnight lending. So when I was talking about sort of the different products and tenors that we have, it's set up very differently. And and we really are trying to be the lender of first resort. The difficulty, right, is when there's a situation where there's a deterioration. It's hard not to know whether you're going to end up being kind of closer to that lender of last resort, right? Because you may have already, they might have already borrowed from you, a member, before that sort of crisis hits. So what's been really important from my perspective is the fact that we have ongoing good relationships with the other regulators. So the Fed in particular, but not just the Fed, it's important to have good relationships and continuous communication that certainly amps up during those times with the FDIC, the OCC, the state regulators, so that because they're closer to what's happening with the member, right? They're the actual regulator for that institution. If we ever had a regulator say, don't lend to a particular institution anymore, we would not. But typically, instead, what we're doing is trying to work together to either stabilize the institution, right? That's really what you want to be able to do at the end of the day. You don't want a failure. Or we're working together to try to allow for some time. So in particular, the FDIC can kind of get their plan in place as to how they want to move forward. I think we've really encouraged institutions to make sure that they are set up with the Fed for borrowing. One of the things I think we saw during the crisis in 23 was not everyone, even though they might have had access to the Fed, that they weren't necessarily set up. And if we're set up in advance, we have really great processes with the San Francisco Fed to allow us to move collateral pretty easily. So that doesn't become an issue. But it does mean that the member has to be set up with the Fed. They have to make sure that their agreements are in place, that the pipes are working, that they, test that from time to time, just like our members will test borrowings from us if they're not currently an active borrower. And so I think those things become more important. We've always had those lines of communication and working together. I think certainly it's amped up
Yeah, yeah.
since the crisis.
You've heard Vice Chair Barr and other Fed officials talk about this idea of, it's not enough to know that the discount window is there. You should be regularly testing your ability to access it. There's even been this thought of, should Federal Reserve potential borrowers, should they be pre-positioning some collateral there? And that sounds similar to what you talk about, the way the process works with the Federal Home Loan Bank, that there's always collateral there ready to be borrowed against for a lot of your members. How do you think about that?
Yeah, so I mean, I think the way we've been able to set up our processes with our the Federal Reserve Bank in San Francisco is that we're able to set it up so that that collateral could be moved over, because the concern is that if and I think you see this raised by folks like Governor Bowman and others, that if you pre-position collateral at the Fed and it's just sitting there, and hopefully most of the time institutions aren't in a stress situation. So you're
Right.
sort of putting that collateral over there. And what does that mean in terms of reducing the level of credit that's in the marketplace for consumers and businesses, especially small businesses? So while I understand the argument, I'm not so sure it's necessary to do that. I think there are other ways to structure how we work together to address that, right? And if you have that in place prior to a stress situation occurring, then it should be relatively easy to move that collateral over.
Yeah. Yeah. And well, let's move now. Let's do a little truth in advertising. It said we were going to talk about reform of the system or potential reform of the system. So let's hit a couple of topics, but I think the background we covered will make this flow much easier. So, if you think about some of the changes, is 11 the right number of Federal Home Loan Banks? I know the regulator could bring that down to 8. And any thoughts on whether that's an important direction of change, further consolidation?
Well, I think that, when you think about what we do and how we really get involved in sort of what's happening in our local communities, how we, administer our affordable housing programs, how we think about targeted lending, all of those things require us to know a lot more about what's going on in the communities we serve. And so I think the regional structure is important. What that number is, I won't try to, get into. But Congress would need to make a change. And if there's really any view to do something different. And yes, while the regulator has the ability to go to 8, I believe that the way that's written, it really is for purposes of addressing safety and soundness
Got it.
issues. And and I think the banks are very healthy. At this point, there's been a lot of focus on making sure we have retained earnings, we have excess retained earnings. So I'm not sure there's a safety and soundness reason to do any consolidation.
So another emphasis, certainly from MBA's perspective, has been in broadening the membership categories. So you talked about who's eligible to be a member today. I mentioned just that the mortgage market has changed so much. Independent mortgage banks are majority of origination and servicing now. And real estate investment trusts, REITs, are important long-term holders of mortgages. So your thoughts on whether the membership would expand to reflect today's marketplace?
Yeah, and if you recall, Mike, REITs were members at one point, right?
Yeah.
And there was a regulatory decision to not have them be members going forward. So I don't know whether or not our regulator would be interested in re-looking at that, or whether, again, they would be looking really to Congress to make a decision about what the membership should look like. It's interesting because since it is a cooperative structure, right, I think the bigger questions that are sort of posed are making sure that whatever is done doesn't sort of negatively affect the overall safety and soundness of the Federal Home Loan Banks themselves, or negatively affect the members that are currently part of the cooperative. One of the issues that comes up often is this issue of a prudential regulator, right? I mean, the members that, with the exception of the CDFIs, which are a very small percentage of the membership, the other certainly the depositories, the banks and the credit unions have a prudential regulator. And so the question has come up, if IMBs had a prudential regulator, would that be sort of viewed differently? And certainly as someone who's been the general counsel of an IMB in the past, I look at it and go, wow, we've got 51 regulators, right? Because
Exactly.
in addition to working with the GSEs, and but I think it's been more of sort of the type of regulator that you would see with respect to an OCC or an NCUA or the Fed.
Right. You mentioned AHP, which is at 10% now, but you said a number of the banks have gone to sort of 15% voluntarily. A lot of the reform discussion is, well, why not 20? So maybe talk about, I know we were talking previously that there are some trade-offs involved at some point there, but how would you think about expanding the AHP requirement for the Federal Home Loan Banks?
So, you know, I think there's a legitimate discussion about what's the percentage, right, that should be given that I think will be an important policy discussion going forward. But I think one of the things that we've seen, and we've gotten to the 15%, is how that money is used. So as an example, last year when we and our board committed to go up to 5%, we piloted a middle income down payment assistance program, right? Because remember that the down payment assistance program under AHP is for folks that are 80% or less of area median income. Well, that's tough in California and Arizona and Nevada because the cost of housing makes it difficult. It's also harder to engage more members because
Right.
because of that threshold. So what we did was we put out a program that was between 80% and 140% of area median income. And it was taken up so quickly. We did $10 million to pilot this program last May. The money was all called for by before the end of August. Was committed. And we believe that our ability to really serve what the needs are in our region, we shouldn't have the ability to sort of determine how best to use any additional monies that we're using. So we've done housing counseling programs where they're matching grant programs with our members. We've invested some money in trying to start looking at how we could build capacity for tribal nations. But I think there are a lot of needs that we have seen, and we believe that we're in a good place to sort of direct those monies. And we still believe that the FHFA has the ability to determine whether or not we're staying in the bounds of
Right.
supporting affordable housing and community and economic development.
Well, Teresa, it looks like we're pretty close to the end of the time here. I really appreciate your thoroughness and comprehensive overview of the history, the structure of the system, some of these reform ideas that are being tossed around right now. But want to give you a chance, any closing comments you want to make before we turn it back to Mary Biddle and Rob?
Well, I think that certainly as federal home loan banks, we believe that we are important, just not as federal home loan banks, but really to make sure that there's a diverse and vital, stable banking system in the U.S. where there are smaller institutions that can serve the communities that we serve, the smaller communities, the rural communities, the small businesses. And so I think in terms of thinking about any reform going forward, there are often things that seem like they sound good on, initially, but I think it's important to really understand the ramifications so that there aren't unintended consequences, but ones that in fact are foreseeable, that really harm the institutions, the financial institutions in the country, our economy, and the consumer.
Great.
But
Well,
thank you for the time today. It's great to spend the last hour.
Thank you, Teresa. And thanks to everyone for joining us. I don't know, Mary Biddle or Rob, if you had any closing comments you wanted to make, but appreciate people staying with us through this hour today.
Thank you all very much for joining us, and the recording will go up on our website at some point next week. And look forward to tuning in May as well. Thank you very much, Teresa, and thank you very much, Mike.